Hi, I'm Isabel Barrow, Director of Financial Planning at Edelman Financial Engines. I'm joined by Christopher Jones, Edelman Financial Engines Chief Investment Officer. We are here today for you, our clients. We've all seen the headlines about stocks entering a bear market and heard talk of the possibility of a recession, and we understand that that can be unsettling. Our priority is to help protect your wealth and move it forward, even in challenging times. Today, we'll give you our view on what's going on in the markets and the economy and tell you what we believe may happen next and what it all means for your finances. So let's jump right in. Chris, thanks again for joining us today.
Thank you, Isabel. It's great to be here.
Chris, since 1929, bear markets have lasted about 10 months on average, and we've been watching the markets go down for most of 2022 already. What could prolong this bear market's drawdown, and is there a high risk of that happening?
Well, every bear market is different. We've had 26 of them since the 1929 period, and they've ranged in duration anywhere from 1 month, like we saw back in 2020, to as long as almost 3 years. So it's a little difficult to say that there's a typical bear market or a typical economic downturn. Every situation is a little bit different. So, what is the situation we're in right now? Well, we're in a situation where the Fed is trying to slow down a very fast growing and sort of dynamic economy right now. We've got a situation where demand is in excess of supply, and that's pushing up prices, namely inflation, to levels that we haven't seen for about 40 years. And the concern that markets are expressing is that the Fed might overcorrect and actually push us into a recession, which is not where we're in right now, but is something that is possible in the future. So one thing to keep about in mind about bear markets is they tend to be much more common than actual recessions are. So, for example, if we look over that same period of time since 1929, there have been 26 bear markets, but only 15 recessions. Are we actually going to tip into recession, or is there just going to be a bit of a slowdown, and then the economy can resume growing? In terms of what might actually push us into a situation where the bear market lasts for a longer period of time, the big concern is just a global slowdown in growth. And because of the conflict in Ukraine, because of COVID, because of a lot of things, there's just a lot of uncertainty as to what might happen in the preceding months or preceding year.
Chris, I hear from clients often that is this time different? So I guess I ask you, is this time different?
Well, the short answer is it's always different. Every time we go through one of these situations, there's a different set of circumstances and a different environment that we're in. And so, really, there's no such thing as a typical bear market or a typical recession. The circumstances are always a bit different. What is perhaps a little bit different about this situation compared to what we've experienced in the last 30 or 40 years is that we are actually in a pretty good economy right now. Labor markets are strong, corporate earnings are strong, consumer and corporate balance sheets look pretty good. There's not a giant overhang of debt in the market like we had back in the financial crisis. Generally speaking, with the exception of inflation, things are pretty good economically right now. And what's happening is the market is reacting to expectations about what the Fed is doing. That is, they're trying to slow down the economy, and the worry is they'll slow it down too much, and that'll tip us into a recession. So it's a little bit different than what we experienced back in the financial crisis, where the underlying economy was the big root problem, and that caused financial markets to decline. Keep in mind that markets are always forward looking. They're always thinking about what's going to happen, not what's happened already. It's already priced in the likelihood that we're going to see some significant slowdown in the overall economy. And whether the market goes up or down from here will depend on whether things get better or worse than what the market already expects.
If this drawdown were to take another 6, 10 months, should we sit on the sidelines and wait it out? And if not, why not?
It does not make sense to try to wait out a market downturn. And one of the big reasons for that is that in periods of uncertainty like we're in right now, where markets are volatile, is where you see some of the biggest positive returns in the stock market. So if you try to sit out the downturn by removing yourself from the market, you actually have a pretty high likelihood of missing some of those big positive days. And it is those big positive days that in the long run provide you with that longer term expected return.
Chris, we've been hearing from clients. Why does it seem like their diversified portfolios haven't protected them as much as they expected? A portfolio with 60% allocated to stocks and 40% allocated to bonds is already down about 20%, almost as much as the S&P 500. So, why are these more moderate portfolios not holding up better?
What's been sort of unique about this particular downturn is that we've seen a big decline in the prices of bonds, mostly because of the expectation that higher inflation will yield to higher interest rates. The Fed will push up the interest rates for borrowing and for lending, and that obviously has a negative impact on the price of bonds. Now, that doesn't mean that bonds and other asset classes aren't still providing additional or improved diversification. It might surprise you that the best returning asset class so far this year is intermediate government bonds. They're down about 7% so far year to date. Now, down 7% isn't great, but it's much better than, for instance, large cap growth stocks, which are down almost 30% year to date. So different asset classes will behave differently, and there is benefit to diversification. It just so happens so far in the first part of this year, we haven't seen the traditional, really obvious benefits of having bond exposure in addition to equity exposure. But those correlations will change over time, and I would certainly expect, as we think out over the next few months and next few years, that bond diversification will play a very important role in helping to protect the value in people's portfolios.
Another common question we've been hearing from clients, Chris, is well, in part a comment, which is what if there is a recession? And if there is it a typical recession? What can our clients do to help protect their portfolios?
Business cycles come and go, and we typically will go through periods of time where there are downturns in the economy, where unemployment can go up and so forth. And so, the question of whether there's going to be a recession or not is not really the most important question. The point that I would emphasize here is trying to figure out whether that's going to happen or not is a very, very difficult game. And the idea that you're going to outguess all of those sophisticated institutional investors and hedge funds and everybody else that's trying to game this out is really, really difficult. So the best strategy is to stick with an investment strategy that is diversified, that is tailored to your time horizon and your specific needs, and to stick with that as much as possible. Now, I recognize there may be situations in your personal life where, hey, maybe you need some significant fraction of your wealth accessible in a very short period of time. In those situations, you should be talking to your advisor to figure out what makes sense given your particular circumstance. But if your time horizon is measured in years, which the vast majority of our clients are, then you should not be sweating whether or not we go into a recession in 2023 or in the latter part of 2022. Whether that happens or not has largely been anticipated or largely been priced in by the market, and market prices could change in unexpected ways going forward. The best thing to do is to stick with that diversified strategy for the long run and to make sure that you're building your wealth as best possible.
Thanks, Chris. And for those clients that may be sitting on cash or inclined to keep more of their money liquid than normal, what is the risk of sitting in cash now during a period of high inflation?
Well, the biggest risk is that by sitting in cash, you're allowing inflation to erode the value of your wealth. So if you were to put all your money in cash right now in a period of time where inflation rates are on the order of 7 or 8%, what that means is the real value of your wealth, the actual value that you can spend, is declining by 7 or 8% a year. And that's quite a bit. That's a pretty significant loss to sort of lock in. The benefit of having exposure to equity markets is they are the best long-term hedge for inflation. So when you think about holding periods that are measured in years, the best way to keep up with the impact of inflation is to have exposure to a broadly diversified portfolio of equities, including things like real estate and commodities and all the other things that come along with holding a large diversified portfolio of equities. Those are the things that will help you keep up with inflation in the long run. And so it may seem somewhat counterintuitive, but actually moving to cash is a pretty bad idea, particularly in an environment where inflation is high.
Timing is everything. So, Chris, We've heard the term stagflation in the news quite a bit, and we've heard comparisons to the 70s, to the 80s, and that inflationary environment. What is stagflation, and are we experiencing it? And what steps are you taking to help protect our clients'
Sure.
portfolios?
Well, stagflation is another one of those terms that gets bandied about, but it's not really very well defined. Generally, what it means is a period of time where inflation is higher than normal or higher than sort of the recent history would suggest, and economic growth is either slower than normal or actually possibly even negative if we happen to be, for instance, in a recession. The most recent and most prominent example of this was the oil shock that we had in the 1970s. Now, in the current situation, we're not seeing an energy shock of the magnitude that we saw back in the 70s, but the price of oil is up about 20%, mostly because of the conflict in Ukraine and the additional demand coming out of the pandemic. Now, what should you be doing differently? Well, not as much as you might think. What you want to do is to continue to maintain that diversified strategy. Now, what are we doing behind the scenes? We're always reanalyzing and remodeling all of this information as it comes available each month to make sure that we are allocating your portfolio in the way that will best achieve the expected return and risk objectives that are part of your financial plan. So it's a constant process of reevaluating and reassessing and making adjustments as necessary. Sometimes those adjustments can be intuitive, sometimes they're a little less intuitive, but they are designed to keep you on track to make sure that you hit your financial objectives and your financial goals.
Chris, we've talked about the significant headwinds they're facing the financial markets and the economy. So, what does someone do who's retiring next year or someone who needs to start their required minimum distributions soon?
Sure. Well, the main thing to keep in mind is that you want to focus on the things that you can actually control. What are the things that you can control? Well, in a high inflationary environment, one of the ways that you can deal with that situation is to avoid buying things that are higher in price right now. Now, obviously, things like gas and food and so forth, you have to buy. I mean, we have to eat, we have to drive. But other things like big ticket big ticket purchases, for example, like a new car, maybe that's something that you want to hold off on right now because we're in a situation where the prices of new cars are pretty high, mostly because the supply is constrained. Maybe in a year or two that won't be the case, and so if you can put off some of those big ticket kinds of purchases, maybe that vacation home you don't need this year, maybe you should wait a year or two, for example, that allows you to sidestep some of the impact of that inflation. Now, we're also in a period of time where the market is down and people's portfolios are down. And so the question comes up, well, if I'm just about to retire, or maybe I just retired, what should I be doing differently? Though many of our clients, I would suggest, actually are not in a situation where they really need to delay retirement. They might just be doing just fine. And one of the things that our advisors can help you with is doing an assessment and saying, okay, market's down, your portfolio might be down a little bit. Let's reassess and take a look at where you are, and let's make sure you're on track to meet all of those goals and objectives. And in many cases, the answer is yes, you're doing just fine. It's not the kind of downturn that we're seeing right now is not that unusual. And many people have multiple sources of income and wealth that they're going to be relying on in retirement. Many of those things have not changed with the market downturn. If we look historically, the stock markets go up more than they go down. Bull markets last longer than the average bear market. And at some point, the market will reach a bottom and will continue to grow again. And we'll go through another cycle of expansion like we've seen in the past. The precise timing of that is very difficult to figure out. But over the long run, a diversified exposure to stock markets is what provides the best mechanism to grow your wealth over time.
Thanks, Chris. We'll leave it there. We especially want to thank you, our clients, for joining us today, and we hope that you've found this discussion beneficial. If you have further questions related to your finances, please don't hesitate to contact your financial planner. We're here for you. Edelman Financial Engines has guided clients through a range of economic environments for 35 years, and you can count on us as your partner to do the same for you.